Yeah, let me open the model up real quick. So there's sort of two ways to look at doing a DCF or DCF-like analysis. So the way I like to start is doing what I call like an implicit DCF. So basically, I'd like to solve for the current market stock price, which is usually a reasonable assumption. Like I've said a couple times, I think that 90, maybe even 95% of stocks are fairly valued by the market. That's adjusting for beta factors. So just pure alpha factor. I think most of alpha is squeezed out by, what you have right now in front of us. Market participants keeping their ear to the ground, trying to ferret out information. The market weighing mechanism is amazing. There's a lot of case studies. I did one of my own just for fun one day. I stood up and did a 360, modeled off my unique physique, and I asked the crowd to submit a weight estimate. There are hundreds of people, and their range of weight estimated from 50 pounds off on the low side and more than 50 pounds off on the high side. And I had a scale right there, and they weighed within 1 pound. The average weight of guesses was within 1 pound of my actual weight. And if you need more evidence of the wisdom of crowds, not the madness, but the wisdom of crowds, I think the stock market is a really good example. It's easy to forget about the wisdom of crowds because people think, okay, well, Tesla went up 20x, so how smart can the crowd be? Well, the crowd is still really wise. It's just that the crowd, when you look at a price, the crowd only has a one-dimensional, think of it as an x-axis, I guess, a one-dimensional tool to sort of estimate a future price. And that one-dimensional tool is current price net of risk. So Tesla was quite cheap in hindsight. We all wish we bought Tesla before the split at a low price. If you don't, then, I don't know what's wrong with you. But I certainly wish that I bought Tesla before I realized that they would make billions of dollars of cash flow and have a ton of revenue growth that I didn't expect, and they would produce really efficiently when everybody thought they wouldn't. So now the problem is, of course, 2 years ago, nobody could tell you that with accuracy, right? No, there was a lot of risk. Tesla looked, in fact, really risky. Their CEO seemed to be a bit unhinged. Their production didn't seem to be going great. Their sales didn't seem to be growing great. So the risk-adjusted price, which is kind of a funny way to look at it, but that's sort of the mean consensus or the mean current market price, was fair because people sort of understood that all these things could go off the rails and the company could go bankrupt. As the company proved itself, it went up. So it's a little tautological, but I think that it's important to understand that the crowd gets the price right all the time, in essence, by definition, and that it's important to always respect the market price. Now, you may think that the market's pricing in the risk incorrectly, and that when you looked at the risk of Tesla 2 years ago, you said, oh, pish posh, there's nothing wrong with what's going on here. It's perfectly normal for a CEO to make a fake hostile bid for a company. It's perfectly normal for that same CEO to be smoking weed and doing all these crazy things, and that revenue will shortly be skyrocketing. And you would have been paid for that risk, right? But you're taking a risk unit for a reward unit. It's just that the market is pricing that risk unit differently from the way you price. And I think AMC is much the same. So I do this implicit DCF to try to get a sense for what is the market pricing. And so when I plugged in my numbers up till 2030, I have AMC returning to probably on an inflation-adjusted basis. Let me sort of do that as we speak. So on an inflation, the peak revenue they had was $5.5 billion. And that was in 2018. I'm sorry, actually the peak revenue they had was $5.5 billion in 2019, but it was very, very close to the 2018 revenue. The peak EBITDA they had was $850, which is more than the 2019 EBITDA of $690. So anyway, if I inflation adjust, let's see here, let me give it 6 years at 4% inflation, which is a little higher than probably reality. Yeah, so I basically have them getting back to maybe a shade under, in fact, their peak revenue adjusted for inflation. So obviously the 5.5 billion revenue in 2019, whenever COVID kind of normalizes, maybe that'll be 2024, hopefully tomorrow, but whenever, the movie business sort of normalizes, you basically getting back to the same revenue is obviously less utilization because prices will have risen. In fact, in this year, 6-7% inflation, so quite substantially in this year, but probably around 2% the years prior. So anyway, I have them sort of just getting back to, maybe even you could argue, a little bit under their peak revenue, and I have them getting back to roughly the peak operating margin. So with that assumption and a 7% discount rate, which I think a few people probably rightfully criticized as a little generous. I don't agree that it's generous, but we'll get to that in a second. But again, you could pump it up to 8%. You get a roughly $11 a share price target. So, I think that, again, I look at the stock market and say that, again, I shouldn't be seeing bargains every second. If you look at 20 stocks and you think 11 of them are cheap, or 15 of them are cheap, or even 4 of them are cheap, you and I are not looking at the same stock market. Most stocks are not cheap. Most stocks are not so expensive that you short them either. I think for every 10 stocks I look at, and I think 100 to 500 hours is a good starting point. And that may sound like a lot, but again, you can divide that over a team. You can divide that over time, many years sometimes, to study an industry. That's the homework you have to put in before you really understand something. For something like AMC, I might invest 300 hours into it, but then for the next 2 or 3 companies similar to it, I only have to invest 100 hours. But I don't think you can get away with, say, 5 hours of homework on a company and start trading it. I think that's sort of a great way to lose money. So anyway, this implicit DCF, I basically try to solve for something that's, I don't curve fit for the current stock price, but I probably try to sort of nudge it a little bit closer, like a Ouija board. Buffett always likes to say that he wants to ignore the current stock price completely. I think in practice that we can't necessarily do that, although when you do an M&A deal, like a private equity deal for a family-owned business that hasn't traded in a million years, you don't have a current market price, so you have to sort of guess it. So based on the operating performance and the financial statements. So for me, I picked a 7% discount rate, no terminal growth rate, at around a $700 million terminal cash flow, which is less than their peak, or terminal net income, I should say. And use a pretty high tax rate as well. But it is a U.S. company. That's something that is important to keep in mind. When you have an MNC, you can kind of get away with a 10-15% tax rate. When you're a completely U.S.-based company, which AMC isn't 100% U.S.-based, but when you're a U.S.-based company that's doing U.S. deals and there's no argument where you can offshore IP and stuff like that, you basically are at the mercy of the U.S. corporate tax rate, which is quite high, 35% or 38% at the moment. So, in the long run, I do think they'll have to pay that kind of tax, which is somewhat unfortunate. So anyway, I get, like I said, around $11, which is around the current stock price. I basically say that they'll go back to their old, operating cash flow. So I think that the bears are missing this idea that, the movie business is going away and that it'll never be the same again and things like that. And if you actually look at box office, was not really dropping in 2019. In fact, it grew in 2018. So between 2017 or 2016 and it's sort of been in this low growth pattern for the last 10 years. So, and that's not exactly while Netflix was non-existent. I mean, Netflix was around in 2012, 2015, 2018, 2019. Netflix was doing great, in fact. And if anything, we got confirmation that the movie business isn't going away through things like Scarlett Johansson's spat with Disney. And also, the music business is a good analog where people sort of assumed that nobody would ever buy CDs again, and therefore streaming would crush prices. And there was a big music bear industry for a long time, and a few bold investors stepped up and bought out Warner Music. And those companies now trade for insane high multiples, and people said musical is actually kind of having this nirvana where it's actually a brand new industry that's now a growth industry, which is really funny because for a while there it was left for dead. So I think that the bulls don't have it right in the sense that I don't think that this company and its CEO in particular are going to pull a rabbit out of the hat and actually create new businesses out of nowhere. Most new businesses are boondoggles, right? So every business on the planet wants to create new business lines and grow their business, right? And if you ever took some MBA classes or whatever, you probably studied Coca-Cola. And every time Coca-Cola tries to come out with a new product, and there are several others like Ford and others, it's sort of a flop. And, inevitably, sometimes you do get new business lines. Look at the AirPods, for example. But by far and large, it's really hard to just say, let's take our capital and invent some new business. It's really difficult. The more adjacent it is to your current business, kind of the more probability you have to succeed. But it often is really hard. And a lot of times, I've seen this a lot in pharma. If you assume that every new business venture that the company is undertaking is going to be successful, you'll get pretty wild models where every stock is really, really undervalued. Now, this is your bet as an investor, right? You have to bet on management. If management's right and their new efforts are not boondoggles, but they're, boons, then great. You will do really, really well. If AMC can sell popcorn in homes and in supermarkets and things like that, great. That could be more EBITDA. I don't see it. And I'm certainly not going to value it as if it already is successful, right? They're starting from a standing start. So if you've ever started a business, even started a new business line within a big business, which certainly I've tried to do, it's not easy. You still are sort of a startup within a big business, and you still have a serious chance of failure. Just because your other business is doing well doesn't mean your new business that's basically a startup is going to do well. So I think a lot of the bulls kind of miss that starting a new business model too, which is what AMC seems to be doing by being like a merchant bank or kind of investing in other companies. I think that's kind of a big waste of time and probably going to be a negative return, probably a waste of money. You have companies like Biogen that tried to get out of multiple sclerosis by doing a very close adjacency in neurology, and they failed. If you're making MS drugs, you're talking to neurologists, so why not make Alzheimer's drugs? Why not make Parkinson's drugs? Well, Biogen has tried that for 25 years, and it hasn't worked. And they've had different CEOs. They've poured billions and billions of dollars into it. It's frustrating. It's not easy. So, again...
Right, and that's a way more logical step than a movie theater company buying a old gold mining corporation.
Yeah, the gold mine is an embarrassment, and it makes management look bad. It basically says that... It sends a signal to investors that... In fact, when you do model something called return on invested capital, or there's a couple of ways to sort of model, I like to use ROIC, is basically just what is management going to do with the cash balance. And it becomes this really nice way to make this assumption. So I don't have any ROIC for the business because management is signaling to me that they don't know what to do with their capital. That, in essence, that if there's any excess capital returned, that I'm not sure I trust them to spend it in a way that's going to generate any returns for shareholders. Management gets paid a lot, which I didn't like. It's just a brief examination, but board of directors members here make $300,000 plus, which is a lot of money for a board of directors seat. That's an awful lot of money for checking a box and kind of showing up once a month. The CEO makes a fortune in cash. I'm talking about straight cash here, not just RSUs and PSUs and things like that. I'm not sure I really like how management is selling. So all the signals that management's going to do this really great new business endeavors thing doesn't look good. I do think that basically an idiot can run a movie theater, and probably an idiot does. And I think that if you look at the actual business, it's actually really impressive. It doesn't take a genius to do this business, and their film margin is actually pretty good. If you look at the actual film admissions revenue, sort of ticket stub revenue minus film revenue, it's about a 50% gross margin. So basically, for every dollar that you charge in tickets, 50 cents goes to Disney. I mean, that's pretty good business because you also have food on the side, right? So you make money on the food and you make money elsewhere. But
actually, the first 2 weeks of a release, usually it's like 90% to studios.
Well, I'm just looking at the 10Q, so maybe you have better information than that. But the admissions revenue, say in 2019, was $3.3 billion, and the film costs was $1.7 billion. So that leaves around $1.6 billion, which is roughly 50% gross margin, as I defined it. The food and beverage business is way, way better, which is hilarious because you'd have $1.7 billion of food and beverage revenue and only $300 million. So you'd have $1.4 billion of food gross margin, which is crazy, right? I mean, that's where sort of most of the profit is generated. But you still have not a bad business. You have a 50% film gross margin business is kind of like an 80% food gross margin business. Now, the problem is, of course, you have to operate a theater, which is gigantic. It's very expensive to operate a movie theater. So you add in a whole bunch of other margin here. But you have plenty of margin left over, kind of 15-20% operating margins So it's a fairly healthy business. And I think that anybody who thinks like this business is going away, they're not going to get back, they'll get back to making $500 million to $1 billion of EBITDA. I don't think that's going to be a problem. And then I think they'll be able to pay their loans, which is the important thing. They've been able, they survived a very close brush with death. So I don't think they'll have, and this is getting back to the bear thesis, to play fair for both sides, I don't think they're going to go bankrupt sort of servicing their debt. So what looks like a really interesting trade here is a cap structure arbitrage. So basically that means you buy the debt and short the stock. And in fact, if I think it's interesting, having looked at this for about a week, again, about 15 hours, maybe 2 hours a day, then I think the rest of Wall Street probably thinks it's pretty interesting. Now, let's take that and think about it some more and say, all right, well, if me, who's been out of practice for 5 years, says, hold on, you buy the debt, you get 20 or 30% in your pocket, you short the stock, and no matter what happens, basically you make money. If the debt goes to par, you make 20% yield plus the debt going up. And your stock will go up too, of course, so you have to hedge it right. But convertible hedgers do this for a living. So what's more likely? There's a nefarious short scheme to take this company down, or it's just the market doing what the market does, which is that, oh, look, here's a free 20 or 30%. That sounds really good. I want to buy the debt, short the stock, and I'm going to make free money. Well, that's why the short interest is so high. It's not because there's a bunch of people trying to short into bankruptcy. It's because there's a bunch of smart investors who say, this looks like a really good arbitrage. I can make free money. In fact, if I were a stockholder of AMC, I might consider buying the debt instead of buying the stock. The stock is riskier than the debt, of course. That's just how that works. But some of this debt trades like a stock. In fact, you get limited upside, right? So if the bonds trade back to 100%, or you get redeemed, or you get paid out in full, you can't get more than 100%. But do you want more than 100%? I mean, I'd rather have the bond doubling, or the bond going up to, say, 50%, although you can buy, it looks like you can buy some bonds for 60, 70 cents, which usually means a company's going to restructure or go through bankruptcy. Of course, if it's 10 or 20 cents, then it's almost a certainty. But at 60 cents, it's a serious risk. So anyway, to me, that seems like a better play. Buy the debt, and if you want a little hedge, maybe you short 10 or 20% of the stock as a little hedge in case you do see a credit event, or a euphemism for bankruptcy. So if you're short the stock and the company goes bankrupt, you make a lot of money on the short, but you're going to lose some money on the debt. Now, that all depends on the workout, right? And the problem with owning debt in a Delaware bankruptcy is the workout can take quite a long time, and you got to sit there with this illiquid piece of debt. Now, the debt's still trading. You can sell your debt, but for the average investor out there, you don't want to do this. In fact, the average hedge fund usually doesn't want to do this. But if you're special made to trade distressed debt, you're sort of sign up for it, if you will. So anyway, those are some quick thoughts. I'm sorry if I didn't answer your question, but basically what I'm trying to say is I don't think the business has to do anything but just get back to where it was before COVID, which I don't think is going to be that big of a risk, to be frank.